Welcome to Analyzing Finance with Nick. We've done the iceberg of finance, economics, and wealth management, and now we're going to do our next iceberg, which is the iceberg of options and volatility. Why are we doing this one? One, I think this is something a lot of people don't know that much about. Yeah, I have a pretty strong expertise. I worked at one of the largest options market making hedge funds for 3 years as a research analyst. And I do a lot of options related work for my clients at my current wealth management firm that I am a partner at. So I figured I would kind of share my expertise and kind of go down the layers of the iceberg in the world of the derivatives market. First iceberg, as a disclosure, there's nothing on here as investment advice. Please do your own investment research or retain an investment advisor. I'm not going to answer any specific trading related questions in these videos. So if you have those kind of questions, instead of the comments, I recommend just contacting me directly, either through email or my consultation form. Now, without further ado, let's get started with layer. Yeah, that's market makers. Next are the Greeks. I did a whole video series on the Greeks way at the beginning of this channel, but the Greeks are these letters in the Greek alphabet that basically explain certain properties of options, that certain things move based on certain effects on the underlying. Like delta is the most common Greek. That's the change in the value of the option with the change in the price of the underlying asset. Gamma is the first derivative of delta, or the second derivative really of the option price itself, where how much does the option price move? How much does the delta change based on the change in price? So that's what gamma is. And then there is rho, which is the change in the option price with the change in interest rates. And then there is theta, which is the change in the option price with the change in time. And theta is usually always negative if you are buying option and positive if you are selling options, because options, a lot of the value is the time value. And the longer dated the option, the greater the theta has. But theta is not evenly distributed. It doesn't, like if an option is 100 days, it doesn't decline the option price doesn't decline 1% every year. Even the theta doesn't decline 1% every year. Most of the theta decline is concentrated in the last 30 days. Generally speaking, is where it really starts to accelerate, because the real probability of the option either hitting the target if it hasn't already, or to fall out of the money if it already has, declines very quickly when it's closer to expiration. And then Vega, which is the change in implied volatility, is the implied volatility, and the change in the implied volatility with the change in price. So there's also a few other more obscure Greeks, but these are the ones that I'm just going to cover here. You can watch my Greek series if you want to know more. Skew is the net bias directionally of the vol surface and the vol, usually skew is negatively biased. That puts at the same distance away from the underlying tend to be more expensive than calls, because a lot of people use options to buy insurance. However, when there is kind of a retail driven euphoria in the marketplace, that skew might shift to being positive. But skew is really just the measure of how much does tails cost compared to closer in the money options. The greater the tail costs, in terms of implied vol, I'm not talking about outright prices, because the fact that these are such low delta and low gamma out there that depresses prices. But it's just in terms of pure implied vol, if the implied vol gap is wide in favor of the farther out of the money option, it means that people are anticipating a bigger move than expected, or that there is a risk of a severe tail event is higher than normal. Whereas if that spread is narrow, then that means people think the market's not going to move very much, or is very complacent, or volatility is so high already that because they're already down in the dumps in the market, that there's no real point to have a certain big hedging. You don't hedge after the horses have ran out of the barn. So that's skew. And then Black-Scholes is the famous formula by Fisher Black and Myron Scholes, which was the options pricing model. So how options are calculated. Most of the components of options, such as the price of the underlying, the time, the delta, can all be pretty easily calculated. But the key breakthrough with Black-Scholes is it allowed traders for the first time to price implied volatility Because volatility, unlike all the other components of the Black-Scholes formula, which I'll post on here because it's a very long formula. I think I might have talked about this on the Iceberg of Finance, is a derived variable. You can't just measure, it's at least realized volatility you can measure because you could see what moved in the past and you can compare that to historical and get an idea of what percentile it's in and what the move was. Whereas implied volatility, since it's what the market expects in the future, you can't really just analytically put that in. You just put in the other variables and you can derive the implied volatility. And what is implied volatility is the expected move in the options price, the expected volatility, the expected standard deviation of potential outcomes that the option is pricing in at the current moment. Usually when vol is low, it means the market is complacent. When vol is high, it means that people are scared on an index level. For single stocks, vol can be high around major events such as earnings or anticipated corporate actions, or it can be very low if there are no anticipated events, or if a company is getting acquired and the deal is highly likely to go through and it's already at the deal price, then the implied vol would be extremely low. So it's really situational, and looking at the implied vol and the changes of implied vol over time can possibly tell you something about the future price patterns of the underlying. And also it's a good measure to tell if you're over or underpaying for an option, because if the vols are higher than what you think it realistically is going to move, or what you're relative to your price target, then that option is expensive and may not be a good way to make a directional movement, or might even be a good opportunity to sell volatility if it's too high. But that is implied vol. And layer three, I kind of keep going off of. A lot of this stuff is kind of all derivative, and no pun intended, or maybe it was a little intended, of the stuff I've previously of talking about. And so trading vol versus trading delta. Delta's directional trading. You're trying to use a stock or an option because you think an asset is going to move a certain way and you want to take advantage of that. Or if you're trading vol, you're betting on implied volatility, whether it's going to move up or down because the market is over or under pricing the risk of an unusual event. And so you don't need the stock to move a single direction, one or another. You just need to move, either more or less than expected. So there are circumstances where the directional trader and the vol trader can win. So say, for example, you have a directional trader who's really bearish on a stock. I think it's going to go down 25%. So they buy a put at the money that's worth about 10% of the underlying. And if the stock drops 20%, the directional person will win and the vol market maker will lose because it moved more than expected. Whereas if the stock only drops 10%, the directional guy is technically right, but it didn't move down enough for him to take advantage of the profits because the option was priced at that level. And so the market maker is going to win in that scenario. But actually, I'm going to use a better example for this. So the directional and the vol trader can win, but not necessarily at the same time, but not necessarily if they trade it the same way. So if a directional trader is short the equity market, I'm just going to scrap all of this. But yeah, there's just a difference. And then the vol smile is just the shape of the skew. So it's the implied level of volatility at each level of out of the moneyness or in the money of the option. And it's a smile because it's oftentimes that the implied vol is higher at more extreme levels or more out of the money options and is lower at the money options. So the vol creates the vol term structure creates a smile in that way. And then if you want to take it more to a three-dimensional model where you include not just the volatility and the out of the moneyness, but also the dates, you create a 3D image which kind of looks like a blanket in a way, called the vol surface, which shows how the volatility changes not just at different in the strike levels, but also at different dates and times. So you can have a term structure is just really how vol, I'm going to clarify this. Term structure is the term I just been throwing out there, is how the vol changes at different strikes. So maybe the June strike of an option is at a vol of 20, And the September strike's at a vol of 15, and the December strike is at a of 30 because there's an election coming up. And so that's the term structure. The vol smile is the change in volatility over different strikes. So that measures skew to a certain degree. And then you have the vol surface, which combines the term structure and the vol smile in a single 3D plane, which is kind of looks like a digital blanket when you run this in a chart. So that's kind of how different ways you can analyze volatility relative to date, relative to in the money, etc. Now we are going to be talking about the European